Welcome. It is fantastic to have you joining us for today's deep dive.
It really is great to be here.
Because today we are exploring a really fascinating hybrid business model, one that comes out of the UK.
Right.
It's essentially a framework that blends ruthless business efficiency with, well, a bleeding heart, the Community Interest Company, or CIC.
Yeah, it's a model specifically engineered to foster socially inclusive economies.
And just a quick source check before we get too far into the weeds. Today's deep dive is based entirely on a highly detailed Wikipedia article. It breaks down the history, the statutory rules, and the operational mechanics of CICs.
Which is incredibly helpful. It gets right to the core of why corporate structure actually matters for social change. It's about a light-touch regulatory approach that completely changes the game.
Okay, let's unpack this. Because historically, businesses had a very stark choice. You either made money for your shareholders,
Which legally binds you to shareholder primacy.
right? You had to maximize those financial returns.
Yeah.
Or on the flip side, you could structure as a registered charity.
But if you do that, you're relying heavily on donations.
And you typically have to surrender strategic control to a volunteer board of trustees.
Exactly. There really wasn't a structurally sound middle ground.
No, there wasn't. Like if you wanted to aggressively trade in the open market, but permanently lock your profits toward a social mission, you were just out of luck.
It was a massive bottleneck for social innovation.
So let's talk about the birth of the CIC. First off, you'll see the acronym CIC, but it's usually pronounced CIC or colloquially just KIC.
Kick, right.
And the origin story of the KIC really highlights that gap we were just talking about. Before 2005, UK limited companies that didn't have charitable status couldn't easily guarantee their assets were locked to a public benefit.
Yeah, it was nearly impossible to do securely.
I mean, couldn't founder just write internal rules saying the profits go to a good cause?
They could, but those rules were always vulnerable. A shift in the shareholder majority or, a buyout, and the new board could simply rewrite the articles.
Well,
They could strip the assets and pivot the company right back to traditional profit maximization. There was no ironclad way to lock the wealth into the public sphere without becoming a formal charity.
so where did the actual solution come from? Because it didn't just appear out of nowhere.
No, it didn't. The source details a pivotal proposal from 2001 called The Case for the Public Interest Company.
Okay.
This was authored by Paul Corrigan, Jane Steele, and Greg Parston, and they were actually heavily influenced by the American Public Benefit Corporation model.
Interesting. So they looked across the pond for inspiration.
Exactly. And their research had some major institutional backing. It was funded by the Gulbenkian Foundation, Gordon Roddick, and the Office for Public Management.
But taking a theoretical proposal and turning it into a legally recognized corporate form, that takes some serious legal engineering.
It does, and the architect widely credited with doing that is Stephen Lloyd.
Right.
He was a lawyer who basically took the concept of a public interest company and engineered the specific legal framework for the community interest company.
He figured out how to integrate this entirely new hybrid into existing UK corporate law.
Yes. And his efforts ultimately culminated in the Companies Act 2004, which officially introduced them.
And the market response was staggering. The source notes that 10,000 kicks registered in just the first 10 years.
Which is an explosive adoption rate for a totally novel corporate structure.
10,000 in a decade. That's 1,000 a year.
If we connect this to the bigger picture, it proves there was a massive pent-up demand.
For entrepreneurs who wanted to do good.
Exactly. Thousands of entrepreneurs actively wanted to build robust trading businesses aimed at complex social issues, but they were deterred by the charity model.
They wanted the agility of a standard company, but with a legally binding guarantee that the public good remained the ultimate beneficiary.
Precisely.
But they can't just slap a label on their business and say they're doing good, right? There have to be rules.
Oh, there are very strict rules. A CIC must pass a community interest test.
Meaning what, exactly?
It relies on the legal concept of the reasonable person. So, would a reasonable person consider that the company's activities benefit the community?
Okay, so it's an objective, common sense assessment.
Yes. But the legislation is also very specific about what a CIC is expressly forbidden from doing.
The exclusions.
Right. They cannot be primarily political.
Makes sense. You don't want this becoming a vehicle for partisan lobbying.
Exactly. They also can't serve an unduly restrictive group.
Meaning, I can't start a CIC where the defined community is just my immediate family.
Or a small, exclusive syndicate of your business partners. No, the beneficiary class has to be broad enough to represent a genuine public interest.
Okay, what else?
Obviously, they cannot do anything unlawful. And, crucially, they cannot be an actual registered charity.
We're definitely coming back to that charity point because that is a massive distinction. But here's where it gets really interesting. The asset lock.
Ah, yes, the defining characteristic.
Break that down for us, because this seems like the engine of the whole framework.
Yeah, it is. The asset lock ensures that the assets of the company, whether that's cash, intellectual property, or real estate, are perpetually applied for the benefit of the community.
So if a KIC acquires prime real estate, what legally prevents the directors from selling it at a massive discount to a private shell company they secretly own?
The asset lock neutralizes that exact threat. If a CIC sells an asset, it must be for full, objective market value. You cannot gift it or sell it at a discount to a private entity.
And what happens to the money from that sale?
It has to remain entirely within the CIC where it stays locked for the community purpose.
What if a company shuts down? Say they fulfill their mission and decide to close up shop. Who gets the remaining wealth?
It cannot legally go to the members or shareholders. Any surplus must be transferred to another asset-locked body.
Like another KIC or a charity.
Exactly. The wealth is structurally trapped within the public benefit sector.
But wait, building a business takes capital, and investors usually want a return. If the assets and surpluses are locked, how does a KIC attract investors?
The model does accommodate private investment. A CIC structured with shares is legally permitted to pay dividends to shareholders and interest to financiers.
Okay, so investors can get paid.
Yes, but, and this is a huge encyclopedia, but those distributions are heavily restricted by statutory caps imposed by the regulator.
So the state fundamentally limits the upside.
Exactly. You can get a reasonable return, but you aren't going to get those exponential venture capital style gains. The cap structurally prevents shareholders from extracting the majority of the wealth.
Okay, so a KIC has all these restrictions. It has to prove its public benefit, it locks its assets, and it caps shareholder returns. But earlier you said it cannot be an actual charity.
That is correct. Ipso facto, it is not a charity.
Even if it does the exact same good work.
Even then. In fact, because it lacks charitable status, it doesn't get those tax exemptions. A CIC is liable for standard corporation tax on its trading profits.
Just like any normal business.
Exactly like a conventional business.
So what does this all mean? Why would anyone intentionally choose a CIC, accept dividend caps, and agree to pay full taxes when they could just be a tax-exempt charity?
It's a great question, and it really comes down to operational agility, board dynamics, and executive control.
Explain the board dynamics part.
When you establish a traditional charity, you usually have to hand strategic authority over to an independent volunteer board of trustees.
To guarantee objective oversight.
Right. Furthermore, the founders of a charity generally cannot be financially remunerated for their board service.
So a classic founder's dilemma. The person with the vision and the drive is forced to hand over the steering wheel to part-time volunteers, and they can't even draw a competitive salary to sustain themselves.
Exactly. For a lot of high-performing entrepreneurs, that is a complete non-starter.
But the KIC framework eliminates that friction.
Completely. An entrepreneur can dedicate their career to a social enterprise, draw a market-rate salary, and retain strategic dominance over the company. The strict charity limitations just don't apply.
That structural reality completely changes the game for talent retention in the nonprofit sector.
It does. Plus, the legal definition of community interest for a CIC is intentionally broader than a charity's strict public interest test.
Which gives them more operational flexibility to tackle modern social challenges.
Yes. And it's also fascinating to see how these two distinct legal structures can strategically interact.
You mean KICs and charities working together?
Yes. The legislation actually permits a traditional charity to convert into a CIC.
Why would they do that? Giving up tax-exempt status seems counterproductive.
It's almost always driven by the desire for commercial freedom. If a charity feels bottlenecked by trading restrictions or trustee governance, converting to a CIC unlocks that potential.
Though they need charity commission consent for that.
They do. But conversely, and this is a masterclass in organizational structuring, a registered charity is legally permitted to own a CIC as a wholly owned subsidiary.
Oh, wow. So the parent charity keeps its tax-exempt status, while the subsidiary CIC goes out into the open market to aggressively trade and compete.
Exactly. And in that specific parent-subsidiary relationship, the standard dividend caps do not apply.
Because the sole shareholder receiving the dividends is a charity. There's no risk of private wealth extraction.
Right. So the CIC can generate unrestricted profit and funnel 100% of that capital upward to fund the parent charity.
That is incredible. Let's shift gears slightly and talk about the execution. For someone listening to this, maybe considering the framework for their next venture, how hard is the actual incorporation process?
The bureaucratic friction is intentionally kept very low. It's surprisingly streamlined.
Okay, what's the first step?
The foundational requirement is using the correct corporate shell. A CIC must be incorporated as a limited company, either limited by shares or limited by guarantee.
So you cannot use an unincorporated association?
Correct. The legislation explicitly forbids that.
I would expect the paperwork to be a nightmare of bespoke legal filings.
You would think so, but it actually leans heavily on standard corporate infrastructure. You file the standard formation document, Form IN01, along with your memo and articles.
Is there anything specific to the kick?
Just one specialized requirement, the Form CIC 36. This is where the directors formally articulate their community interest case.
And submit it to the Registrar of Companies.
Yes. And the financial barrier to entry is engineered to be highly accessible. The standard fee is just £35.
£35? That's nothing.
And for entities registering online, a process they introduced in March 2019, the fee is reduced to merely £27.
Wow. They really removed the financial friction. Can an existing company convert to a kick just as easily?
Yes, the conversion process is equally streamlined. They just pass special resolutions, pay the £35 fee, and submit a Form CIC 37.
Which basically verifies they aren't a charity. But wait, if the incorporation fee is under £30, the paperwork is standard, and the regulation is supposedly light touch, what legally prevents a bad faith founder from passing the initial test, making a ton of money, and then just paying themselves an exorbitant executive salary to bypass the dividend caps?
What's fascinating here is how the framework addresses ongoing accountability without stifling the business.
Okay.
Light touch regulation is not an absence of regulation. Every single year, a CIC is legally mandated to file an annual report. Form CIC 34.
And this goes to Companies House?
Yes, alongside their standard annual accounts.
How does that enforce accountability, especially regarding executive pay?
The CIC 34 serves two critical functions. First, the directors have to provide tangible evidence of the social impact they delivered over the past year. They have to publicly defend their mandate.
And the second function?
Second, the report mandates explicit confirmation and transparent disclosure of all directors' remuneration.
So the financial data is completely exposed.
Precisely. If a founder tries to circumvent the caps with a massive bloated salary derived from community funds, that decision is documented and publicly accessible.
And subject to regulatory scrutiny.
Exactly. The transparency requirement ensures the asset lock works.
And who is actually overseeing all of this?
A dedicated statutory officer created by the 2004 Act, the regulator of community interest companies.
Appointed by the Secretary of State for Business and Trade, right?
Yes, for a term of up to 5 years. The current regulator is Louise Smith. She took over in September 2020.
And she also serves as the Chief Executive and Registrar at Companies House.
Since 2017, yes. And housing the CIC regulator directly within the leadership of Companies House sends a very clear signal.
That kicks aren't just marginal side projects.
Exactly. They are mainstream, commercially viable entities embedded right within the standard UK corporate infrastructure.
And the regulator has real power, right? Like intervention powers.
Absolutely. If a CIC intends to dissolve, but their founding articles fail to specify an asset-locked body to receive the residual capital, the regulator holds the authority to step in.
They decide where the money goes.
Yes. They mandate and approve the final destination of those funds. The community's wealth is protected right through to the entity's final dissolution.
It really is a brilliantly engineered piece of corporate law. As we wrap up this deep dive, the community interest company just stands out as this incredible structural hack.
It truly is.
It takes the best parts of a private limited company, the agility, the ability for founders to retain control and get paid, the freedom to innovate in commercial markets, and it permanently binds them to the locked-in altruism of a traditional nonprofit.
It harnesses the relentless drive of the entrepreneur, but it neutralizes the structural incentives that lead to pure corporate greed.
Which is exactly what we need more of.
This raises an important question regarding the future architecture of our economic systems. We have operated for decades under the assumption that the default setting for a corporate entity is the maximum extraction of value for shareholders. But the CIC framework provides empirical evidence that social responsibility can be hard-coded into the legal DNA of a company without destroying its commercial viability.
Profitability and public benefit are not mutually exclusive.
Exactly. They don't require separate legal silos. They can be integrated into a single, highly effective engine.
It fundamentally rewrites the boundaries of corporate capability. And that brings us to a final lingering thought I want you to take away from this deep dive.
Go for it.
We've examined how the statutory asset lock proves that businesses can survive, attract investment, and dominate markets without prioritizing relentless shareholder extraction.
Yeah.
So think about the macroeconomic implications for a second. What would happen to our global economic infrastructure if every standard multinational corporation adopted a voluntary asset lock, dedicating even just a fractional percentage of their vast wealth permanently to the public good?
The sheer scale of resources that would be secured for societal benefit would be staggering.
And it wouldn't require a single tax increase. Something to ponder on your own. Thank you for joining us, and keep exploring.